Stocks versus ETFs. This isn't about which one's better, it's about understanding how to use both to grow wealth over time. But before we can do that, we need to understand the difference between the two and how they can be used in ways that fits your personal investment goals. Because investing is not a one-size-fits-all. From the outside, the stock market looks simple. You buy stock, you wait, you get rich. At least that's the story a lot of new investors are sold. On the other side, there are investors who only buy ETFs without fully understanding how they may be missing out on some of this growth by avoiding concentrated bets in individual stocks. And ETFs alone can be your entire portfolio, but it doesn't have to be either or. The market rewards structure. And the biggest mistake that I see new investors make isn't picking the wrong stock or ETF, it's skipping that foundation entirely. When you first start investing, you're immediately forced to choose stock or ETFs, active or passive investing, or should I take more risk or should I play it safe? What's up? My name is Dalal. I've been investing for over a decade now. I've learned a lot of hard lessons along the way. I started from nothing, made plenty of mistakes, and through consistency and discipline, I've been able to create a great life for myself and my family. Now I'm here to help new investors avoid the mistakes that I had to learn the hard way. By the end of this video, you'll understand the difference between stocks and ETFs, how to structure an investment portfolio, how to then align that portfolio with your goals, and which stocks and ETFs you can consider to start your investing journey. What no one tells you is this: stocks and ETFs aren't enemies. When used strategically in the right order, they can do something magical together to help strengthen your portfolio over time. I've watched people hit it big on a stock and then give it all back. I've also watched others play it really safe forever and never really move forward. And I've learned, again, the hard way, that if I had to start all over, how I would maybe do things differently to maximize those long-term effects on my finances when invested in stocks and ETFs. It all comes down to building something that can survive multiple market cycles, because wealth isn't built on top, it's built from the ground up. And I'll show you exactly what I mean here in just a minute. But quick disclaimer, none of this is financial advice. I'm just some guy on YouTube with a mic. Always do your own research before investing, and if you find value whatsoever in this video, please hit that like button. It really helps me more than you know. Now, before we talk strategy, returns, or what to buy, we need to know the difference between a stock and an ETF. Because if you don't understand this part, everything else in investing feels confusing. And that's where most beginners get lost. When you buy a stock, you're buying a piece of a single company. If I buy Apple, I'm betting on Apple. I'm betting on their leadership, I'm betting on their products, I'm betting on their earnings, and I'm also betting on their mistakes. If Apple executes well, then I win. But if Apple messes up, I really feel it. Stocks can create great returns, but they come with concentration risk. One bad quarter, one bad decision, one market shift, and your portfolio will take a hit fast. I've lived through that. Now, an ETF is an exchange traded fund, so let's go ahead and break these words apart and I'll explain each. Exchange, this just means it's bought and sold on a stock exchange, just like a regular stock. Traded, this means it's actively traded throughout the day. And fund, this is the most important part. A fund is a collection, a pool of investments. Instead of owning one company, you own a piece or pieces of many companies inside that fund. Put that together, it's an exchange traded fund, or an ETF. A fund that holds multiple investments, trades on a stock exchange just like a normal stock, and gives you instant diversification in one single purchase. When you buy one ETF share, you're not betting on one company, you're buying exposure to an entire group of companies, sectors, or even the whole market. That's why ETFs are often used as a foundation of a portfolio, because they spread risk, reduce volatility, and let time and compounding do the work. And ETFs trade just like stocks, but when you buy one share of an ETF, you're buying a piece of every company inside of it. For example, when I buy something like VOO or SPY, I'm buying into the top 500 companies in the United States: Apple, Microsoft, Amazon, Nvidia, all in one single purchase. One of the biggest advantages of an ETF is that if a company starts to underperform inside that fund, it's automatically replaced within the fund over time. You don't have to analyze balance sheets or earning calls. The fund does that work for you. And because of that, they charge something called an expense ratio. An expense ratio is simply an annual fee the ETF charges to operate the fund. Remember, an ETF isn't just a ticker symbol. Behind the scenes, there's a team managing that fund, tracking the index, rebalancing the holdings, replacing underperforming companies, handling the admin work and making sure the ETF stays aligned with its goal. That work isn't free. The expense ratio is how they get paid. It's expressed as a percentage and it's taken out automatically. You never get a bill and you never have to pay it manually. For example, if an ETF has a 0.03% expense ratio, that means you're paying $3 per year for every $10,000 you have invested. Low-cost ETFs like VOO or SPY keep that fee very, very small, which is why they're so powerful over long periods of time. The lower the expense ratio, the more that your money stays invested and is compounding for you. It might sound small or insignificant at first, but over decades, high fees can quietly eat into your returns. That's why expense ratio matters, not in the short term, but in the long run. When you're building a portfolio meant to last, small percentages make a big difference. Okay, so now that we know that stocks are about precision, ETFs are about probabilities. Both can make you money, but when you put structure behind them, you can actually get better results over time by using both together. I played around with this a little bit and created this investing pyramid. You can make this your own and allocate whatever percentage works for you in each, but here is how I look at it for a beginner. Again, when I think of stocks versus ETFs, I don't think in terms of which one's better. I think in terms of structure. Most new investors get this wrong because they jump straight into picking individual stocks without building a foundation first. That's like trying to build the top of the pyramid with nothing underneath it. It might work for a while, but eventually it collapses. Not all the time, but based on probabilities, I think the way that I'm going to show you will give you a better long-term result for most investors. At the base of my investing pyramid, I placed broad market ETFs like VOO or SPY. This is the foundation. These funds give me instant diversification across hundreds of the largest and strongest companies in the US. I'm not trying to outsmart the market here. I'm owning the market. This layer is about stability, consistency, and long-term compounding. Historically, these ETFs have performed well over the rolling 20-year period across the last century. And if you can build the habit of consistency with investing here, just keep buying, as you heard me say in many of my other videos, you give yourself a massive long-term advantage. Above this layer is the growth layer. Still ETF, but with more upside and more risk. Funds like QQQ or QQQM and VUG live here. This is where I lean into innovation, tech, AI, and long-term growth trends. These funds are heavier in growth-oriented companies like the Apple, Microsoft, Nvidia, Tesla. This layer adds speed to the pyramid without putting everything on one company. Now, during market crashes, these ETFs do get hit harder than, say, our next one. The next layer is the income layer, and a great example of this is SCHD. This is where cash flow enters the picture. SCHD focuses on high-quality dividend-paying companies, meaning I get paid while I wait. This layer helps reduce volatility, especially during market crashes, and keeps investors emotionally invested during tough times. You can also use bonds or treasuries here if that fits your investment goals better. Only after all of that do I move to the top of the pyramid and add individual stocks. This is where you are exercising a bit more risk. And I usually break this into two parts or two levels. Higher quality established companies and higher risk concentrated bets with more upside, but also more downside. On this top peak here is where you can trade in and out or look at some much more risky plays in comparison to the rest of this pyramid. You can trade options or invest in crypto, really whatever fits your personal investment style better. You can take a lot of risk here. These positions are small on purpose because they sit at the very top of this very strong foundation that we just created. They do not replace it. ETFs make up the majority of the portfolio because funds like VOO and SPY have historically delivered around 10% average annual returns over time. Stocks are optional, not required. When you build your portfolio like a pyramid, you're not relying on luck. You're relying on structure, discipline, and time. And if I were to start over from scratch, this is the path that I would take. Now, you can allocate whatever percentage you want to each level of the pyramid and truly make it your own. The structure is flexible. It should reflect your own goals, your own risk tolerance, and your own comfort level, not someone else's, not even mine. Here is how I would personally structure it. I know for me that I'm more comfortable taking on a bit more risk than most people. So this is why my allocation would look like this. I would put 35% to the foundation, broad market ETFs, so the VOO, the SPY, things like that. 30% to growth ETFs like QQQM or QQQVUG. 20% to the dividend ETFs. 10% to established individual stock. And at the very top, 5% to higher risk plays, so trading stocks, options, crypto, or more speculative positions. Now let's put all this into numbers that we can see. strategy. If I were to invest $10,000, it would look like this: $3,500 in foundational ETFs, $3,000 in the growth ETF, $2,000 in dividend ETFs, $1,000 in that higher quality individual stock, and $500 in those higher risk trades. So start with your foundation and build your way up by increasing your risk, as now you have a solid base and are consistent with investing during good times and market crashes. And this is the part most people overlook. Wealth is built by consistency, showing up when the market is calm and staying disciplined when it isn't. Stocks and ETFs aren't shortcuts, they're tools, and tools only work when they're used with structure. I've had friends that spent a decade buying in and out of stocks and end up losing money. More action and activity doesn't equal more money here. When you build a foundation first and layer diversification and growth and then income before taking on risk, you stop depending on luck and start using a process that has historically worked over time. Most investors don't fail because they picked the wrong stock or ETF. They fail because they skipped these steps, took on too much risk early on, and then let their emotions dictate their decisions. Compounding doesn't respond to fear or excitement. It only responds and respects time and discipline. If we're starting from scratch today, I wouldn't rush to the top of the pyramid. Focus on the base. I'd stay consistent and I let time do what it's always done, because real wealth isn't built in a moment. It's built slowly, deliberately, and with intention through every market cycle. So build your foundation, be patient, and play the long game. If you are still watching, drop a fire emoji in the comments. Let me see you, and make sure to watch this video next.